Let's connect with Gagan Banga to talk about how things have moved for them for the quarter gone by. He's Vice Chairman and Managing Director with Indiabulls Housing Finance. It's a tough quarters for NBFCs and HFCs right now. Gagan, good morning. Thank you for joining us. Overall, it has been a tepid quarter for Indiabulls. Both profits and net interest income saw degrowth in this quarter. What has led to the decline in profits?
Since we announced our merger in April earlier this year, we've been focusing on making sure that whatever impediments can be there as far as the bank merger is concerned, those are done away with. So we've been particularly focused on reducing our commercial real estate book. Over the course of the last quarter, we've brought it down by over 6,000 crores just by refinance, etc. And the regular amortization has anyways happened on the side. So given that, despite the fact that we have disbursed over 7,500 crores, the overall book has come down because the repayments on the other side of our other type of loans that are home loans and LAPs has also been pretty strong. The company is essentially following a philosophy where it over the short term wants to continue to reduce its commercial real estate exposure, focus on the bank merger, preserve liquidity, and continue to remain extremely strong on capital adequacy. So our liquidity has actually gone to very high levels, and today we have over 29% of our borrowings covered by the quantum of cash and liquid investments that we are carrying of about 28,000 crores. So that was generally the theme of the quarter, and through quarter one we focused on this. Through a large part of quarter two, we would continue to remain focused on reducing our commercial real estate exposure.
Okay. Coming to the asset quality, the gross NPAs were up 56% quarter on quarter. What has led to the decline in asset quality?
The overall market conditions, as you're aware, are quite fragile as we speak. We also were fortunate to have a large recovery last quarter, and in continuation with our policy of creating provisions, we have tried to accelerate some loans which could have otherwise continued to remain as part of our stage 2 assets, and created provisions around that. Most of the increase in the gross NPA can be attributed to the fact that we have chosen to utilize the provision release that we got out of the large recovery that we did from the sale of Palais Royal. There is also a marginal impact coming from the fact that same time last year our base was almost 10,000 crores higher. So it is partially an outcome of a 10,000 crore or so lower base, and also our desire to not bump up profits because of the provision release, to actually continue to utilize those provisions. We have been in our recent media interactions talking about the buffers that the business carries. So the business carries roughly about 4,000 to 5,000 crores of buffers, and we would want to use those all towards provisions rather than increasing our profitability in the short term. We believe that that kind of a buffer is a huge strength of the company, and the recovery that we did last quarter has just demonstrated the strength that we've been speaking about in the past.
Right. Gagan, so which are the segments which are showing higher signs of stress, and what is your outlook going forward on the asset quality trends for the coming quarters?
So my sense is that NPLs will stay in the range of 1.5% or so, gross NPLs. We have buffers, as I mentioned, so we would continue to use those if required to make higher provisions. Overall, a bulk of the book is continuing to perform well, and we are being proactive in recognizing wherever we see even a little bit of stress, say in the construction finance space or any such space. We are being proactive in taking provisions towards that. So I would not say that there is any alarm bell ticking there. I think 1 to 1.5% kind of gross NPLs, given the environment in which we are operating, are actually pretty healthy kind of gross NPLs.
Okay. At what stage is your merger with Lakshmi Vilas, and what all documentation is still required, and also what queries that you may have received till now, if you could just highlight that?
So, subsequent to our announcement in April, in May, early May, we approached all the various regulatory bodies through which we need to get an approval, which is the Reserve Bank of India, the Competition Commission, stock exchanges, SEBI, National Housing Bank, etc. We've already received the Competition Commission approval. We are awaiting the other approvals. The Reserve Bank of India approval is actually the most critical approval, following which the other approvals will potentially follow as an outcome of NCLT. So NCLT will call out to shareholders and so on. So as we speak, as we await the RBI approval, we are engaged with the Reserve Bank. It will be inappropriate for me to be talking about the exact exchange of information. On a timeline basis, I am optimistic that over the next 45 to 60 days, we hope to hear back from the Reserve Bank.
Now, margins, Gagan, they continue to remain under pressure. Given that the environment is slightly tough right now for NBFCs and HFCs, where do you see your margins eventually will stabilize?
So we've, for a while been talking about margins to be in the range of 3 to 3/4. As our commercial real estate book, which is a higher yielding book, declines, the margins the spreads do come down a little bit, but that is now starting to get compensated with our enhanced focus on SME lending. So one should be able to compensate the other, and I'm still quite confident that we will stay in the range of 3 to 3/4. We ended last quarter at 3.14. I think we will be in the ballpark of the same number.
Right. You also continue to reduce your exposure to CPs, Gagan. Given the current scenario, how is it that you see your borrowing mix shape up, say, for the next 1 to 2 years?
So we are not, at this point in time, we are more focused on, the bank merger, and therefore putting all our energies behind that. And that is resulting in, as I mentioned, the real estate book coming off, which is itself resulting in a fair degree of liquidity. So from that perspective, we will be doing opportunistic borrowing, but a large part of our fund requirement would actually be generated internally by our portfolios running down. So like we did a $350 million bond offering last quarter, after achieving a BB+ rating on an international level. So those kind of opportunistic borrowings will be done. Our cash levels are extremely high, and rather than doing very high cost borrowings, I would much rather at this point in time continue to use internal accruals to raise whatever liquidity is required for disbursements.
So finally, how do you see the disbursements panning out? What will be the focus area then?
So this quarter, on a gross basis, we will be looking forward to do about 10,000 crores of disbursements, as against 7,500 crores of disbursements that we've done in quarter 1 and in quarter 4. And that number will continue to increase through quarter 3 and quarter 4. A large part of that disbursement will be towards the SME segment, and then wherever our partially disbursed cases are there, we will continue to do that as well, to make sure that our projects continue to do well. So all in all, I think quarter 2 we will look at doing about 10,000 crores of disbursements.
Okay. Gagan, finally, business has slowed in the quarter, and loan assets have also seen a degrowth of about 10%. What is your outlook on loan growth for the entire fiscal?
So we are still quite confident that, a large part of our commercial real estate realignment is already behind us. It would continue. It need not continue at the same pace. So much like we did a large securitization transaction in quarter 3, I think quarter 4 and quarter 1 were about focusing on reducing both from a risk management perspective as well as from the bank merger perspective, reducing the commercial real estate book. After this quarter, we will be at a steady run rate of 2,000 to 3,000 crores of decline on commercial real estate, and our focus on SME has increased. So as far as the second half of the year is concerned, I'm still looking at a fairly healthy loan book growth. For the year, I am quite confident that as a housing finance company prior to the bank merger, through fiscal 20, our book growth should be in the handle of between 15 to 20%.
Gagan, good to have you on the show. Thank you so much for taking the time out and, giving us that picture on how the quarter went by was and, of course, what's really lined up ahead.